Let's get oriented. I'm Lázaro Ulloa, owner and founder of Ulloa Financial, and this is your market compass for the week ahead for Monday, May 18th, 2026. Last week, markets reminded investors that strength and risk can exist at the same time. The S&P 500 and Nasdaq both reached fresh record highs during the week, supported by technology, artificial intelligence enthusiasm, and continued confidence in corporate earnings. The Dow also reclaimed the 50,000 level for the first time since February, giving investors a strong psychological milestone. But Friday, that optimism was tested. Stocks sold off as oil prices moved higher, Treasury yields climbed, and investors began asking whether inflation may be more stubborn than expected. For the week, the S&P 500 finished slightly higher, while the Dow and Nasdaq were slightly lower. Small caps were hit harder, with the Russell 2000 down more than 2%. The pressure came from two places: inflation and interest rates. According to the Bureau of Labor Statistics, April's consumer price index rose 0.6% for the month and 3.8% for a year ago. Energy was a major part of that move, accounting for more than 40% of the monthly increase. Producer prices were even hotter. They rose 1.4% in April and 6% over the past year. That matters because producer prices often show up later in what businesses charge consumers. At the same time, bond yields moved higher. The 10-year Treasury yield climbed to just under 4.6%, its highest level in roughly a year, while the 30-year yield touched 5.13%, a high not seen since 2007. That kind of move can pressure stocks, especially growth stocks, because higher yields make future earnings less valuable in today's dollars. Now let's turn to the consumer. Retail sales rose 0.5% in April, showing that the American consumer is still spending, but the details matter. A meaningful part of that increase came from higher gas prices. Excluding gas stations, sales rose only 0.3%. That tells us consumers are still active, but they may also be getting squeezed. Higher fuel prices act like a tax on the household budget, leaving less room for everyday spending, travel, dining, and discretionary purchases. And that brings us to one of the biggest risks on the dashboard: energy. Geopolitical tensions involving Iran and the Strait of Hormuz remain a major market concern. The strait is one of the world's most important oil shipping routes, and when investors see risk in that region, oil prices can move quickly. That's why the World Bank's recent projection that energy prices could rise 24% this year matters. This is not just a global headline. It can show up at the gas pump, in shipping costs, in food prices, and eventually in inflation data. In other words, what happens overseas can affect the family budget here at home. Markets are also watching U.S.-China relations, the war in Ukraine, global supply chains, and whether any headline could quickly change investor sentiment. So what am I watching this week? First, I'm watching whether the market can hold its recent breakout. Record highs are encouraging, but Friday's reversal showed that investors are still sensitive to higher yields and higher oil prices. Second, I'm watching that 10-year Treasury yield. If yields continue rising, that could put renewed pressure on technology, housing, growth stocks, and other rate-sensitive parts of the economy. Third, I'm watching energy prices. Oil is not just a commodity. It is connected to transportation, to groceries, business margins, consumer confidence, and inflation expectations. It hits every part of our life. Fourth, I'm watching the Federal Reserve. The recent inflation data gives the Fed less room to cut rates quickly. If inflation remains sticky, markets may need to adjust to a higher for longer interest rate environment. And fifth, I'm watching market breadth. It's one thing for a small group of technology stocks to lead the market higher. It's healthier when gains are supported by more sectors, more industries, and more participation. So what does this mean for you? For higher risk tolerance investors, this is a week to stay disciplined, not emotional. Momentum is still present, especially in areas tied to technology, AI, and a large cap growth. But after a strong run, chasing strength without a plan can be dangerous. Review whether your portfolio is too concentrated in one theme, one sector, or one outcome. Opportunity may still exist, but selectivity matters. For lower risk tolerance investors, this is a week to focus on stability. Rising yields, higher oil prices, and geopolitical uncertainty can create sharp market swings. That doesn't mean abandoning your plan. It means making sure your cash reserves, income needs, and risk exposure match your real life, not just the latest market headline. The bottom line is this: markets are still being pulled between strong corporate momentum and rising macro pressure. Earnings and technology are supporting optimism, but inflation, interest rates, and geopolitics are keeping risks on the dashboard. This is why investing is not about predicting a return. It's about knowing your direction, understanding the conditions, and staying aligned with your plan. Stay oriented, my friends, and elevate your legacy.